Welcome back to the Explainer. In our last session, we did some heavy lifting, right? We tackled error corrections, note structure, and those critical differences between US GAAP and IFRS. But now, we have arrived at the grand finale. Think of this as the ultimate quality control phase right before you hit issue. You've done all the hard work preparing the financials, but, as we're going to see today, the notes are where the real story is told. If your notes are flawed, the whole document is flawed. So we're going to build a rock-solid defensive playbook to make absolutely sure your disclosures are bulletproof. Let's get into it.
Okay, let's dive into this. Here is our playbook for today. 1. Common disclosure mistakes. 2. Thinking like an auditor. 3. Controls and team roles. And 4. The period end checklist.
Section 1. Common disclosure mistakes. Let's look at the audit nightmares we can absolutely prevent.
The honest truth here? Most note disclosure deficiencies are totally preventable. Yet they happen everywhere. It's a simple cause and effect. Take boilerplate significant accounting policies, or SSAP. Why does this happen so often? It's the dreaded Control-C, Control-V trap. Teams literally just copy last year's text without actually reviewing it. The fix is super simple. Just review every policy against what you actually did this year. Then we have omitted disclosures for new standards. Imagine this. A team diligently posts all the journal entries but completely forgets to update the corresponding notes. You fix this with a simultaneous standard adoption checklist. Finally, inadequate contingencies. Teams love to only disclose items where a liability was actually accrued. But remember the rule. You've got to disclose probable items and reasonably possible items.
I really want to bring that boilerplate mistake to life for a second. Just imagine an auditor's reading your SSAP, and they genuinely cannot figure out if your company uses FIFO or weighted average for inventory. Or even worse, your SSAP is still referencing some outdated lease policy from before you even adopted ASC 842. No way! To an auditor, this is not just a tiny formatting tweak or a minor comment. It's a major deficiency. It screams that the notes haven't been thoughtfully prepared. Let's check out 3 more frequent traps. First up, missing subsequent event disclosures. Why do teams fail here? Well, because they mentally check out and close the books on December 31st, and they just stop reviewing. But real life doesn't stop on New Year's Eve. Material events can totally happen after year-end. The preventative tactic? Maintain a subsequent events log and update it weekly, right up to the issuance date. Next, related party omissions. It's so common for teams to only disclose formal written agreements while completely ignoring the informal stuff. To stop this, you need a broad annual questionnaire signed by all management. And finally, wrong cross-references. You've definitely seen this one. The balance sheet says see Note 5, but the actual note is Note 7 because someone updated the notes independently. Prevent this with a final, dedicated review step literally just for checking see Note references. So looking at all these common traps naturally begs a really important question. When the auditors finally roll in, what do they actually expect? What are they really looking for when they start scrutinizing our work? Let's pivot and look at this from their perspective.
Section 2, Thinking like an auditor. We are going to reverse engineer their expectations.
And this brilliantly illustrates exactly what we're talking about. To build a strong defense, you have to know what auditors actually want to see, which is organized, concrete support documents. For your SSAP, they expect a completed checklist of all topic-specific disclosure requirements. For subsequent events, they want a signed management rep letter and solid documentation of your review period. And when it comes to contingencies, they don't just take your word for it, they want the receipts. They expect legal confirmation letters, internal assessments, and questionnaires. Same goes for related parties. They want that annual questionnaire, proving all transactions were formally identified.
Now, when it comes to significant estimates, auditors have an incredibly strict expectation. You literally have to show your math. They expect documented support for every single significant estimate. They want to see your exact methodology, they want your key assumptions detailed out, and crucially, they expect a sensitivity analysis if your estimate is hanging close to a threshold that could actually change the conclusion. If tweaking one tiny assumption alters the whole financial picture, the auditor absolutely needs to see that analysis mapped out.
Section 3, Controls and Team Roles. Let's look at your defensive lineup. Let's move to and see how this builds across your team. Because knowing what the auditors want is only half the battle. You have to organize your team to actually deliver it. Step 1 starts with the team member. They are on the front lines handling the initial identification and recording of transactions. Step 2 is the team lead, who steps in to review those classifications, the journal entries, and the disclosure drafts. And finally, Step 3 is the manager, who has the ultimate responsibility to approve final judgments and sign off.
The absolute most critical part of this entire hierarchy is the communication handoff between the bottom and the top. Think about it. The team member is deep in the weeds. Their specific job is to immediately raise a flag on any unusual items, borderline classifications, or judgment calls. The manager relies heavily on those flags, because the manager is the one who has to approve those judgments, talk to the client, and ultimately sign their name to it. Simply put, if the team member doesn't flag it, the manager cannot manage it.
Section 4, the period end checklist. This is your ultimate weapon.
If you want flawless execution before issuance, a period end checklist is exactly how you get there. You've got to use this at every single close. So, the crucial point is starting with your SSAP and policy disclosures. Your checklist must absolutely confirm that the SSAP perfectly mirrors what the entity actually did this period. I'm talking zero leftover boilerplate. You also have to verify that for any new accounting standards, both the journal entries and the note updates are totally complete. Plus, you need to confirm you've assessed the impacts of future standards and disclosed any practical expedients you recently elected.
Next up, your checklist needs to rapid fire through specific note completeness. Let's run through it. Revenue. Do you have disaggregation tables and contract balances? Check. PP&E. Is the roll forward by category and depreciation expense included? Check. Debt. Have you listed the maturity schedule and verified covenant compliance? Leases. Is the maturity analysis and the weighted average terms present? Tax. Do you have your rate reconciliation and your DTA/DTL roll forward? And for stock-based comp, is your option roll forward and unrecognized compensation clearly documented? Every single one of these needs a solid check mark.
Moving right along to contingencies, subsequent events, and related parties, you need to check that your contingency log has been thoroughly reviewed. And hey, remember our warning from earlier. Ensure all probable accruals have a disclosure, but you also have to verify that reasonably possible items made it into the note too. Confirm that your formal subsequent events review went all the way up to the issuance date. Verify that the related party questionnaire was filled out by all management. And lastly, make sure a going concern evaluation was actually completed and documented.
The final section of your checklist is note organization and formatting. Guys, this is your ultimate sanity check. You need to verify that your note numbers actually match all the cross-references in the primary financial statements, so when it says see Note X, it actually points to Note X. Ensure every single dollar amount in the notes reconciles perfectly to the general ledger, no exceptions. Confirm comparative period amounts from the prior year are in there. And do one last sweeping check to ensure there is absolutely no boilerplate language hanging around.
We have covered a lot of ground today. We've decoded the common pitfalls, reverse-engineered auditor expectations, set up a defensive team structure, and armed you with an airtight period-end checklist. Remember how this connects to everything we've talked about in this explainer series? From handling error corrections to structuring notes effectively, it all culminates right here. Because a perfect financial statement is completely useless if the notes tell the wrong story or an incomplete one. The notes are the context. They are the foundation that makes the numbers actually mean something. So as you head into your very next close, I want to leave you with this one thought. Are your disclosures truly ready for the spotlight? Thanks so much for joining me on this explainer, and I will see you next time.